U.S. natural gas futures rose more than 5% to around $3.40, recovering from a 12-week low of $3.17 last week, as new weather forecasts showed colder conditions developing across much of the country. While demand is expected to stay weak for the next few days, colder weather systems are forecast to arrive soon, which should increase heating needs. Some forecasts slightly reduced how cold it may get, but the overall outlook still points to stronger demand ahead. I think this shift is finally starting to show up in the storage projections, which have begun to turn lower toward the end of January. That said, I don't see the signal as strong enough yet to push prices decisively through the $3.50 resistance. Because of that, I think the current setup is especially dangerous for bulls. If the real cold doesn't arrive in the late January or early February window, which is now just a couple of weeks away, I believe we risk rolling straight into the spring shoulder season with a storage surplus. That would be very unusual for the end of peak winter demand and, in my view, clearly not bullish. In that case, we could be staring at a repeat of 2024, when we entered March with roughly a 400 billion cubic feet storage surplus and prices trading below the $2 floor. Nevertheless, I don't expect prices to fall quite that far this time if storage still carries only a modest surplus by the end of February, but I do think sub-$3 prices would be hard to avoid, with the market likely hovering just above the $2.50 support. Still, I hope this bearish scenario doesn't play out. Mother Nature has a way of surprising the market during a La Niña year, and it's entirely possible that the real cold isn't gone, it may simply be delayed into some part of February. From a price perspective, the $3.50 level has become a key focal point for many traders. This zone carries clear psychological significance, and a sustained move above it would likely improve short-term sentiment. If buyers can establish acceptance above $3.50, the market would be positioned to challenge the $3.70 resistance area, followed by the 50-day moving average and additional upside technical levels beyond that. However, if such a move fails to develop over the next few weeks, downside risks would remain elevated. In that scenario, prices could rotate lower and revisit the $3.20 area, where multiple technical supports are clustered just above the critical $3 pivot. A failure of these levels would expose the $2.90 support zone, reinforcing the view that bearish momentum continues to dominate the market. Please don't forget to comment and show some love for the channel. See you next time.